Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi, welcome to Ilanomics. Before we start this week's episode of Ilanomics, I would like to thank all our readers and viewers who have taken subscriptions to ThePrint. Since this is a show about economics, I would also like to tell you that the economics of the media industry have been badly damaged over the last year due to the slowdown and the pandemic and the lockdown. It is very, very tough for independent media organizations to sustain themselves without readers and viewers paying for what they read and watch. Which is why, if you have not taken a subscription to ThePrint, I would appeal to you to visit theprint.in and take subscriptions. We have various options. We have monthly options and we have one-time payment options. And there are options for people who live in India and who live outside India. We here at ThePrint are dedicated to bringing you good journalism, good text, good videos, good images, and you can really help us and support us by taking subscriptions. So please do visit theprint.in/subscribe. So let's get to this week's topic, and this is a very unusual issue that is playing out in the Supreme Court of India, where the most top court of India is adjudicating on an issue of interest payments. And the moratorium which was given to people who have borrowed from banks at the beginning of the lockdown, at the beginning of the pandemic. The pandemic forced the government to announce a 3-month moratorium, and it was subsequently extended by 3 more months. Now the moratorium has come to an end, and there is a debate on waiving the interest on the interest. The government has showed its cards and said that it can do it for people who have borrowed up to 2 crores in MSMEs. RBI has a separate issue with it. The banks have a separate issue there. But the Supreme Court is pushing the government and the RBI to go ahead and give relief to people. So this is something we have not faced before. And we have Professor Ila Patnaik to simplify this and talk about the pros and cons of what is really happening there. Ila, do you agree that characterizing this as an unusual situation would be correct?
Yeah, the situation is very unusual, absolutely. People have gone to the Supreme Court asking for relief in this matter. So the Supreme Court has to consider it. And now the question is that, is this the platform, is this the only platform that the country offers for people to appeal against what a regulator or a financial institution might be doing? And I think let's just step back a little and look at what experts have said on this. The Financial Sector Legislative Reforms Commission had said that this is increasingly complex. Financial sector regulation is a complex issue, as you correctly said. The present situation is unusual, but it's not the only complex issue, that has arisen in the space of financial sector regulation. As the economy and financial markets become more and more complex, this job requires greater and greater expertise. And what had been proposed was a financial sector appellate tribunal, which is where, if you disagreed with what the regulator was doing, you could go to court. Today, that still doesn't exist. And so people have gone to court because they are asking for relief. I mean, this issue, now, just coming to the matter itself, you've got the regulator on one side, you've got the banks, and the owner of the banks in this case is the government. That's one hat that the government wears because it is the major shareholder of a lot of the public sector banks that are, so 75% of banking is in the public sector and the government is the major shareholder. Then you have borrowers. Those who are not perhaps being represented here are actually the most important of them all, the consumers, the depositors whose money is there. And finally, the government not as a shareholder, but the government as the agency, the institution that had imposed the lockdown, because of which these costs arose. So in a way, I would say we have the government in two of its roles. We have the regulator, the RBI, which is represented here. We have the borrowers who are feeling pain of the lockdown, and the unrepresented depositor who stands to lose. And then the one who's never represented in these cases, the taxpayer. Because if the solution comes to bailing everybody out and recapitalizing everybody, then it is the taxpayer who pays. So it's a very, very complex situation, as you said.
So let's talk about the government here first, because we know the Supreme Court is just adjudicating or trying to resolve a petition they are facing. What are the constraints of the government in this situation? In trying to resolve this whole moratorium and interest problem?
Okay, so let's begin with what the problem is. And that is mainly that now the moratorium has come to an end. That means borrowers have to pay back the principal and the interest. And then the one question is, who pays the interest on interest? Because in the period when you did not pay interest, there also built up interest, including on the amount which you would have paid. If we go back to just the first principles of public finance, before looking at the political economy issues and so on, and the constraints of the government, if you just go back to principles of public finance, if the lockdown was imposed as a means to reduce the negative externality, then that's a public good. And in principle, if the government is imposing a cost on a borrower, on a business, the business could have gone ahead and functioned. The business was stopped from functioning because the government felt that if it functions, somebody would travel by metro, somebody by car, you would have customers walk in, and the externality that it would produce would be a negative externality. COVID would spread, in other words. And therefore, the government imposed a lockdown and stopped those businesses from being able to operate. They were not allowed to operate for that. In that very purest sense, that this is the cost that the government imposed on businesses, so the interest on interest should, in that sense, be borne by the government. Okay? So that's one way of thinking about it. As I said, this is from very pure principles of public finance. Many people may not agree with me on this, but I would say that just based on this principle, the government should have paid. Of course, the biggest constraint that the government has is, how much should it pay? Who all should it pay? Should everybody be paid? They should, if we go just by the first principle, but then it has constraints, which is it doesn't have much money. Okay, we know that by GDP going down, tax revenues have gone down, and with that, the government's finances are very highly constrained. So it would try not to pay everybody. And in a society like ours, and what's acceptable is politically acceptable is that you pay the poorer ones. So you pay MSMEs, you pay for personal for those personal loans, you pay for those below 2 crores, but you don't pay for everybody. So they've come up with this proposal that they won't pay for everybody, but they would pay for a few borrowers. And if if you look at the politics of it, then you would say that this seems to be this seems to be an offer which fits both with the economics and the politics of it. That yes, you should be paying, but you can't pay everybody, so you pay some. But then, interestingly, what we see is that it doesn't actually come up with a rollout plan. I mean, the question would be, so from which date onwards should a loan either be prepaid or become an NPA, or you will stop paying interest on interest? So what exactly is it that you're going to do? The day the moratorium ends, there should have been a plan in place. And naturally, then the Supreme Court says, okay, tell me what is your plan. And in case there was going to be, so some of the petitioners had also said that there should be no interest at all paid, not just interest on interest, but no interest should be paid during the moratorium period. Mm-hmm. If you are going to think about things like that, naturally it is the job of the Reserve Bank of India as the regulator to step in and say, it's going to create a bad culture, bad credit culture. It is going to create problems. So then that's where the regulator comes in.
Mm-hmm. And RBI finds itself in a very tricky place right now, because RBI wants the banks to decide on case-to-case basis. There is the KV Kamath panel report, and then the RBI has also prayed to the Supreme Court to lift the stay on classification of accounts as bad accounts or NPAs. Why is this such a tricky place for RBI to be in?
See, one thing is that a regulator should not want, correctly so, a complete extend and pretend situation where there are non-performing assets, where borrowers are defaulting, but the banks are not recognizing them at all. And so, you just don't even know the extent of the problem in the banking sector. Mm-hmm. So it is the job of the regulator to say that, look, I want these loans to be non-performing assets. If people are not paying back, then they should be classified as non-performing assets. The question of negotiating each loan by loan is very difficult in India particularly, because bank officials who we expect would do that job, it is the job of bank officials, are largely public sector employees. And, they have the service rules that they have means that they are governed, they are under all the agencies and they can be investigated. Any bank employee who takes the risk of renegotiating a loan knows that at some point of time in his life, now or even when he's pensioned off and he's retired and he's getting his pension, can get into trouble if there is a sense that he should have given a 40% haircut instead of an 80% haircut or whatever it might be. Okay, so I think the banks, when it comes to implementation, are not doing this case by case, because there's always somebody in the system who would say, I'm not going to sign off on this because it's a risk for me personally. On the other hand, then there are hardly any incentives for him to do so, because he's got his job. It's not linked to what happens to the bank, and so you've got a whole structure that does not permit this loan by loan negotiation because of the public sector status of the bank employees, the managers, the branch managers, and those who give out loans.
Ila, you used a very interesting phrase there, extend and pretend. Can you briefly tell us what extend and pretend is?
That we find a way through which the bank does not report a defaulter as a defaulter. So I stop paying back, but we tweak our norms a little. So suppose a bank was required to report me as a defaulter if I did not pay a loan at the end of 90 days, 3 months. Okay, let's say looking forward, or now it has to start reporting back, say at the end of October. If I haven't paid, the moratorium is over, September, October, I don't pay, November, I don't pay. So if the bank is required to report me as a defaulter, then actually it's a cost for the bank, because once it declares that a loan is a non-performing asset, then it has to hold more equity against it. And so banks prefer to extend the period before which the loan has gone bad, and they want to pretend that the loan has not gone bad.
Good. Wow. That's basically, as you would say, bury your head in the sand, as the English phrase goes. In the end of it, and that's sort of your conclusion in your column also, which will be there in the description of this video. The banks stand to lose here ultimately, and that should be the consideration for the Supreme Court, for the government, central government, for the RBI, because that's what the larger economy depends on. And you're arguing and supporting that case-to-case loan restructuring mechanism. Is that the best solution, Ila?
So in principle, yes. So there's a difference between a prescription and a prediction. If I was to prescribe something, I would say that's what it should be, because that's what you need. You can't take everyone to bankruptcy now. You can't say, okay, impose the IBC and take everyone to bankruptcy. There aren't even enough buyers, and who's going to give loans to the buyers to buy? So ideally, there should be, just maybe a few bankruptcy cases, and the rest should be renegotiated on a case-by-case basis. So that's the prescription. Now, if you were to ask me what is my prediction, then as I just told you, for public sector bankers to actually do this is going to be very, very hard. But then I don't just want to talk about public sector banks every time. So I know.
We have got a lot of comments for our previous video on public sector banks, and we acknowledge those comments here. And we would like our viewers to give us feedback. That helps us to also see how our discussions are being received. Thank you very much for watching this episode of Ilanomics, and we will be back next week with another new episode. And also, if you have any suggestions on what we should take up next, please do send us comments, and we will try our best to accommodate them. Thanks for watching this week, and please do subscribe to our YouTube channel. There are many other videos there, and I'm sure you will like them. Thank you very much.